to our next speaker, who is Mark Tyler. Mark is the Director of Bardeen Finance. In this next session, which we've termed Alternative Finance, and Mark's going to be speaking just on streaming and royalty finance. Thank you, Mark.
Thank you, Matt. Good afternoon and good morning to everybody. I think it's an unfortunate reflection on the state of the world at the moment that when Rolf said that London is the global capital of mining finance, that London is now spread out over the entire UK. And I'm looking forward to the days when we can all get back together in the boundaries of London, and preferably just one room, so that we can enjoy Arthur's great hospitality rather than the stale buns which I'm getting down where I am at the moment. But having said that, let's get into talking about alternative methods of financing for your project. Now, and the first thing I'd like to talk about is a royalty. Now, quite simply, a royalty is an instrument in which a buyer obtains a share of your future production, your future commodity production, over the life of the property by paying a purchase price up front. Now, I mean, a royalty can be for a relatively small share of the metal production, so it can be sort of 5 to 10% of the gold production that you produce if you're a gold producer, or it can be for a much larger share of a byproduct. So, for instance, if you were a copper producer, you could sell all of the byproduct gold and silver that you produce to a royalty company, and then retain the copper, which is important to you for your exposure to the market, without selling any of that. Royalties can be done on all sorts of properties, with some caveats, and I'll talk about them later. They can be done on exploration properties. They can be done on projects that are in construction and that people are looking to finance to put into construction, to build. And they can also be done for mines that are producing already and have been producing for some time, and the company just needs finance for something else. Typically, the royalties are provided by, they started off really by coming with a property that was being sold. So sellers of properties retain a royalty over the property when you get hold of it. But then there was a whole bunch of royalty companies that evolved, that took advantage of the nature of the market, have listed on exchanges and are major royalty providers. Since it became popular, a number of credit funds have had a look at this. And these days it's become extremely popular, so there's a whole bunch of new, smaller, hybrid kind of funds that are looking at this kind of instrument these days. Now, the cost of royalties can vary quite widely. The big listed royalty companies have a very low cost of capital, really, because their investors look at what they get and they say they're effectively getting a share of the profits of a company without taking the downside cost risk and management risk. So they're very attractive on the market, and so their cost of capital is very low. And if you have a good royalty to sell, you can get a really good deal from the guys. Some of the smaller firms, not that they see that the risks are any higher, but they themselves have had to raise money at a higher cost, and so they tend to pass those costs on to the royalty seller, and the cost can go over 20%. Obviously, as the project is less and less certain, the costs will go up. And I think the important thing to remember is that it's like a royalty is like an undilutable equity. And you can, once you've sold 2% of your gold to somebody, it doesn't matter how much equity you raise from anybody else, the royalty holder still gets 2%. So you never dilute them. It doesn't matter how much you actually raise more capital. In terms of the exploration properties, it's really required. It can be done quite easily in a place where individuals own the mining rights, the minerals under the ground, because then the royalty attaches to that property in perpetuity. So it doesn't matter what happens, you can sell it, do what you like. The royalty still gets paid when that project goes into development. But unfortunately, it's much more difficult to do in an environment where you depend on a mining license or an exploration license, because if you ever lose that license, the royalty disappears. So royalties are typically on exploration properties done more or less in North America to a certain extent the UK gold and silver, it couldn't be done, and coal either. Royalty finance is a lot easier to do than normal project finance debt. The providers are really skilled. They know what they're doing. They've looked at hundreds of projects before. They have all the technical expertise. And so they can make their own decisions. They make them very quickly. And the documentation is much simpler. If you've ever seen on these project finance documents, they sort of measure in inches rather than pages, whereas a royalty document is much shorter than that. If you were to do one on an exploration property, I think it's unlikely if you're in Kazakhstan you'd be able to get it away. But if you're doing it somewhere else in the world, I mean, the company would still need to know what the deposit looks like, and they would want to have some information about it, unless they could see just by inspection that it was very large and very rich, in which case they may take an early view. With properties in construction, royalty providers, I think it's safe to assume that a detailed or bankable feasibility study would be good enough to get them to investigate, to have a look at it. If there's bits and pieces that are not fully up to bankable standard, as I said, the guys are quite smart. They know what they're doing. They can certainly take a view, but you have to have covered off all of the important bits and pieces, including the environmental study, the reserves and resources that you're going to be putting into this, as well as legal clarity and the ability of checking out the right to own and produce. For producing mines, obviously, it's much easier. You just need to show a resource statement and the production track record, and they'll take a view on whether you've been operating efficiently. Streaming finance is in some ways very similar, and it's an evolution of a royalty. The main difference is that, well, it's the same principle. Somebody pays you now and takes a share of your future production, but it's a defined stream of your future production. So it can have quantity of the commodity or the duration or the price which they will pay for future production in the future, all defined. So for instance, you can sell 10,000 ounces delivered over 10 years, or you can have 2% of your production for 5 years, and then going down to 1%. You can get a payment of $400 per ounce of gold in the future, instead of just giving it to them for free, and all sorts of things in those sort of fashions. It's unfortunately you can't do a stream on an exploration property. It's very hard to work out what's going to be arising from that. So it's typically done in properties in construction or producing mines, and the people that participate in the market are typically the listed royalty companies. Will look at streams themselves. The credit funds, the big credit funds, the guys who've raised money to take credit positions, they'll do this sort of thing. And some of the smaller hybrid funds will do it as well. Now, streams are effectively a form of debt, subordinated debt. They're certainly not bank debt. You don't have to make payments unless there's production. So it's not something like a strict bank loan. You have to have you make capital and interest payments. But it does reflect on your balance sheet as accounting as a debt. That has to be like that. And I think the other important thing is that the streamers, the guys who purchase the streams or actually give you the money and look at the stream as a debt, so they get repaid, and it's very important for them to get repaid the money that they invest, and then afterwards they'll take some upside in the form of a lower stream of income. It's becoming quite common these days to have a look-back arrangement. In other words, where the streamer will look back at the price of gold over the last N days, let's say 5 days, and they'll pay you the lowest of those prices. Now, it doesn't affect your financial modeling from bank debt, but there's a cost associated with it, but it is becoming much more popular. A lot of the streaming companies, the guys who do provide streams, and I think Philip, who's speaking later, is a company that did do this sort of thing, will provide all sorts of capital not only a stream, they'll provide not only the stream, but they'll look at senior debt, they'll look at some equity as well. So it's quite common for some streamers to look at all sorts of things. And once again, the streaming companies do their own due diligence, and the documentation is much simpler for them. Once again, you'll probably need a detailed feasibility study if you want to get going with all the environmental work and the environment and all that sort of thing, as well as the legal clarity. But you'd also need a full financing plan to show that you have all the money available to build the thing. So that the stream would slot in with the rest of everything. Obviously, for a producing mine, it's less important to do all of that sort of thing. I thought I'd just quickly sneak in metal loans, and I'm trying to hurry through because we don't have a lot of time. But a metal loan, I mean, people talk about metal loans and off-takes and prepaids all in the same sort of breath, but they're very different things. A metal loan is effectively where a lender lends you some money, or lends you metal. You can convert it into money and use the money to build a mine, and then you have to repay metal over time. You have to pay so many ounces back to the lender over time, and it's really just a loan with a metal price hedge. So you know, because it's all converted back into financial terms, it's really just a loan. A similar instrument is where the lender will do a prepaid, where they'll pay now and receive metal in the future. Typically, that's not over a very long period of time. It'll be over a few months, but it's a similar basis. Metal loans are provided by all sorts of people, including in the old days by banks, but credit funds will do it, and metal traders are quite active in the market. The approval process in many cases, especially for banks, you might as well be borrowing project finance and doing a hedge. It's the same sort of due diligence. It's the same investigation that's required. If you're doing it through a metal trader, it's probably a little easier, but in other cases, it can be about as slow and as expensive as non-recourse project debt. High yield debt is really just it's a different kind of. It can be structured to look like all sorts of things, but what it really is where a lender lends money, gets repaid over time, and takes some sort of upside and credit yield enhancement, either through high interest rates, equity options, metal options, streams, or any other enhancement. It's important to understand what the guys are doing, what their motivation is. Some of them are just in it to get money, to make money, but some guys actually will lend you money knowing full well that you won't be able to repay it, their ambition then is once you default, they'll take over the company. The requirements for this sort of stuff is very wide, and you can do all sorts of. You can even borrow money for exploration activities, bearing in mind that the intention there is probably the ambition is to take over your company. So I mean, I think I just wanted to back up. I think I got ahead of myself. When we talk about offtake finance, I mean, it's really just offtake financiers will just do all of those instruments for any one of those instruments for the ambition of obtaining the metal offtake. And so you can get any kind of stream you like. It's just that you have to sell them the metal. The metal that they buy at all sorts of, they'll buy it at market prices if they need to, or they'll buy it from you at a discount. Now, in terms of all of these instruments, I'm saying there's many of these options. If you've done it before, you've probably wasted your time listening to me. You haven't learned a hell of a lot. But if you haven't done it before, I think it's very useful to have an advisor to take you through this. It's not complicated stuff, but the options there's quite a lot of options, and the fashions and flavors change on almost a monthly basis. So it's very useful to know what's available at this particular time. I mean, as I said, assuming you're not in North America, I think it's just about impossible to obtain any kind of finance other than equity for exploration or feasibility studies. And the instrument you may get was probably, even if it doesn't look like equity, it is equity. It will be equity. And now, I haven't got a slide to cover this, unfortunately, but I thought I'd just quickly run through earn-ins as well. Now, earn-ins are a form of finance in which you as a mineral, you own an exploration property, somebody earns a share of your property by doing some work, by spending some money. Now, they may spend that money in the form of doing work themselves and charge you for it, or they may actually pay someone to do that work for them. But the bottom line is they spend some money and they earn a percentage of your company, of your project, of your asset. The reason they would do that is in order to, majors will often do that with junior mining companies. They'll spend some money. The junior finds some ground that looks good, does an initial reconnaissance, and it looks very good. And then the major will actually think that it's possible there's a worthwhile project in there. They'll spend the money to have a look at it. If it turns out that it does meet their hurdle rates, I think that as a junior, your problem is going to be that you will be required to match their funding going forward, which can be very difficult. And then you'll end up having to dilute. But if, on the other hand, they don't find a major project, it's almost as if you're better off, because they'll typically hand you the project back, and you can continue to develop it with other people, having had someone spend a lot of money to do a lot of definition for you. It's a useful thing to do, but it's also something you could do the other way around if you wanted to. Matt, thanks very much. That's all I have to say.
I'm back, and thank you very much, Mark. That was exceptionally interesting and useful. There are some questions for you online, but I'm going to hold those over for the Zoom session, and hopefully you can stay to answer those questions when we move on to that. But we need to move on to our next speaker, Philip Clegg from Orion Resource Partners. He's a portfolio manager there.
Thank you so much, Matt. Okay, good morning, everybody. I'm going to spend 10 minutes or so talking about Orion and what we do as a representative of a private equity firm, an alternative finance provider to the mining industry. So we start off with this cover slide here. Really kind of a nice slide, isn't it? This is an example of an asset that we've actually financed, provided a comprehensive financing solution to. This is actually Victoria Gold, which is in the Yukon, Canada. You can look it up and have a look at the deal we did there, but in effect, it's a combination of debt, of stream, and of equity, and I'm going to come on and talk about those comprehensive financing solutions in a moment. But before I do so, if we move on to our next slide, I'm going to give a bit more background as to what Orion is and what we do. So Orion has become, it's a relatively youthful organisation. Was established about 9 years ago, but it's become quite large. We now manage over $6 billion in capital, and all we do is mining. We're 50 people globally. I'll come and introduce some of those people in a moment and what we do, the teams that we have. But in terms of our strategies, we have two main strategies, and that's to provide mine finance for companies that wish to construct assets, and provide mine finance to companies that wish to go and buy through M&A purposes, producing assets. And we do that by providing a sort of comprehensive, flexible financing solution. So people see Orion as a kind of a one-stop shop company that can provide that flexible financing solution right across the capital structure. We invest globally. We predominantly do look at developed markets, but we do also look at emerging markets. And because of the size of the funds, we now look at investing rather large chunks of capital, which lends itself nicely to construction finance and M&A finance. Typically, you'd see an Orion deal of $100 million plus. So here is our team. As I mentioned, we are global. The mothership of Orion, should we say, is in New York. We have a technical hub that's in Denver. We have a 5-strong investment team in London, which includes myself. And we have Sydney that looks after our sort of Australian and Asian business. The investment team of Orion is kind of 18 strong now. It's headed up by Oscar Lanowski, who's our CIO, and 5 portfolio managers, of which I am one. We have 4 members of our technical team, and it's supported by our risk team and investment committee, which I'm going to talk about in a moment. There's also a team here called Merchant Services, and that team looks after our physical metal trading, which is part of the holistic financing solution that I mentioned. In terms of when we invest, as I mentioned, we really do focus on later stage value creation. So that's the construction of assets and also the acquisition of producing assets. And this curve here shows you, it's a very standard curve that you see in the mining industry. And it shows you that where do you normally create value, ignoring commodity prices for a moment. Exploration, there's excitement. Scoping studies, perhaps more excitement, and you can see that the enterprise value of a company will typically rise at those stages. Then it kind of takes a breather, hiatus as you go through feasibility and permitting, and then it comes to building the assets and then producing. So for us, we don't do the exploration stuff. It's not our expertise. What we do is we build and we create value that way. So this is probably one of the most important slides and is one of really the secrets behind Orion's success. And it's all about that one-stop shop, all about that flexible financing solution. So as you can see here, there's a diagram of what we call the capital stack. You might have heard this as the capital structure. At the top of the capital structure, as is normal, you have senior debt. So that might be traditionally provided by banks. Banks have somewhat retreated from the mining sector, and firms like ourselves have stepped in. So we can provide senior secured debt. We can also provide mezzanine debt, which obviously is further down the cap structure. And that would constitute probably about a third overall of our portfolio. In the middle there, you have production-linked instruments. And this is really what Mark eloquently described previously. So we will provide those royalties, those streams, those offtakes, and those metal loans that Mark described to you. And then at the bottom of the capital stack is equity. And I'm going to pause on equity for a short while and talk about this because I think it's important in the context of what we're talking about today more widely. And that is that when we think about equity, we think about it in two ways. That we either invest as a minority partner in mining companies, or we'll invest as a majority partner. And the reason we do this is something that's sacred to the private equity firms like ourselves, and that is all about the liquidity event. How do you get out of your investment? So our funds will last for between 7 and 10 years. And at the end of that period, we have to get out. We have to have visibility over that liquidity event. So if we're in a minority position, particularly of the publicly traded stock, you can get out. You can get out relatively easily through trading on the exchange or potentially through M&A of the company. But if you're not in that situation where you're a publicly traded company, and I think that a number of the companies that we've had a look at in Kazakhstan and Turkey and similar companies do tend to be private companies. It's more difficult to do so because you just don't have that exchange to be able to exit. And so in those kind of situations, what we will either look to do is look for a majority position whereby we can actually control that exit, or alternatively, you look to create some form of structure around the equity that would allow you to exit, whether that's through a preference share or some other similar structure that provides for that exit. So that's the investment approach that we have. And what I would say is that it's flexible. So it's not like you do a deal with Orion and you have to take every single part of that capital stack. It's kind of a menu, right? And you can choose what you want. It's a discussion between the parties, and we design the deal all around the needs of the counterpart. So if you look across the portfolio, as I mentioned, if you look at the strategy aspect here, you can see that it's about a third in debt, in production linked, and in equity. But what are the other characteristics of the type of stuff that we look to do? So within each fund, and each fund is round numbers about $2 billion, we do 15 or so core deals. So that's that 100 million plus number that I mentioned to you. In terms of the commodities that we like to invest in, for our flagship funds, which is the thing that I've been talking about so far, we kind of look to hedge a little bit. So half of the portfolio will be in gold and perhaps other precious metals. And then half of the portfolio will generally be in base metals with a few exceptions. In terms of stage, like I mentioned, it's very, very important to us to be later stage investors. It's what our expertise is what we know. And so it's construction and a bit of production. Okay. And as I mentioned at the beginning, the two strategies that we have are the financing of the construction of mines, and then some will be M&A. And then finally, geography, as I mentioned, emerging markets are important to us. and I would argue actually increasingly important to us. So what's it like to do a transaction with a private equity firm like ourselves? Well, I would say that this kind of slide you will see no matter which private equity firm you would go to. So you basically just go through a process of screening. You look at a deal, do you like it? Do you not like it? And I'd say at that stage, sort of 95 out of 100 deals will probably not proceed beyond that point. But if you like it, you'll propose some terms, and that's typically done through a term sheet. If the terms can be agreed, you then enter a due diligence process. It's headed up by the investment team, but we also use our risk team and our technical team and our merchant services team that deals in the product to assist us in that regard. And we use external consultants to look at all aspects of a company and the deal. And then what happens with ourselves and with most private equity firms is that you then take that deal, having done all that work, to a committee, and you get it. They basically vote. They will vote on whether or not to proceed with that deal that the portfolio manager has presented. And if the vote is yes, then you take it through to documents and you close. In terms of that process, typically speaking, although I would add it does vary quite significantly, from the moment that you screen that deal through to closing is probably about 6 months for us. It sounds like a long time, but there's a lot of work that one needs to do, and actually it's quite quick. And in fact, the thing that I would say about Orion is that we pride ourselves on two things: an efficient process and closing. We have a reputation for being flexible in the approach and for closing deals. So it's, we would argue, compared to some of our peers, relatively low execution risk. Worth spending a little bit of time just thinking about due diligence and what we do in that regard. As I mentioned to you previously, we do look at all aspects of a company. We expect that there would be a wholesome data room that would be provided to us that goes through everything, particularly technical, but also thinking about things like product, thinking about things like your management team, thinking about things like your geography. And one aspect here that is actually really close to our hearts is ESG. And I think this is actually quite a valid point to make in the context of this forum, and that is that this is just getting increasingly important to Western investors like ourselves. And so what we do as a matter of course now is that every single deal we do, we will evaluate according to the IFC performance standards on environmental and social sustainability. Hugely important to us, now also important to other private equity firms and lenders in the space. And what we say to provide that additional amount of flexibility to companies is that maybe you're not there yet, maybe you're not compliant yet, and that's fine, but you must aspire to be compliant. And we will add those kind of things to our documents to ensure that that does take place.
Philip, that was really excellent. I'm sure there will be a lot of questions. Okay, we're going to move on to the next speaker, who is Nigel Harper, who is the Director of Remote Site Solutions, and he's going to be talking about that all-important aspect of mining finance, which is making projects investor-friendly. Thank you, Nigel.
Thank you, Matt, and good morning and good afternoon to everybody else. The past participants have done a great job of explaining a lot of what I was going to talk about. So what I would like to do is just quickly go over the first few slides and then talk more later on. So obviously there's different finance options for mining. There's equity capital, which is being gone through, there's debt, and there's also structured finance where there's no simple solution. And that generally is a combination of all the things that other people have actually spoken about. It's mixing up the various royalty streams, debt, equity, and there's also some clever solutions as well which can come about. Attracting finance, it's not easy, as most people will have actually mentioned. Having a good asset and project is important. Having a good management team is even more important. Without a good team, you really can't get a project up and running. Having a clear path and strategy to successful include capital requirements is again important. You know, the investors need to see that you understand the proceeds and understand what is required to get to the end. And having all the supporting paperwork from third parties for validation is extremely important. And having startup capital. Without having that startup capital, you can't pay for those things. You can't pay for independent consultants or validations or even lawyers. And it's extremely hard to get off the ground if you just don't have any startup capital. And also understanding your exit. Investors need to understand that if they give you money, how do we get it back? Same as the banks. How do you repay the loan? How do you actually make sure that people do get what they want? It's never easy. It's not easy at all. Knowing your asset, knowing the type of project you want to do, understanding it from A to B is very important. Understanding your market. Does your asset or project, will it rise in value? Will it decrease in value? Have you got a depreciating asset? You know, will the world still want your mineral in 10 years' time? Will the market change? Will, for example, cobalt keep going up, or will there be batteries made out of other materials? This is something that you need to understand. And that comes under the macro events that actually makes all these changes. That we're changing from oil and coal, which are some projects are now considered stranded, into renewables, which are considered more profitable and intend to be more profitable as time goes on. And know how to mitigate these risks, understanding how and what you need to do to make those risks acceptable to your investors. It's very, very important. So how do you get from A to B? And how do you actually make the small steps, and how do you make the big leaps? Well, to start with, actually understanding all the various points of your project does actually help people to make a decision. And you've got to make a decision whether you do it in small steps, either you raise a small amount of money to start with, and then raise a little bit more and a little bit more, or whether you've got the right type of project that an investor can look at, or a group of investors can look at, and decide, yes, this is something that we can throw a lot of money all at once. You'll see in tech, for example, that some of these people raise hundreds of millions of dollars from day one, whereas you could be struggling to raise 10 million in one of your projects. It seems that the world is difficult for a lot of people, and this comes down to the team. It comes down to actually having the right team that can deliver the right parts of any project. And then it's also important to understand, how do you contend with aspects such as default or risk or trouble that can actually come about. A lot of the projects we deal with, remote site solutions and our private wealth office, is in third world countries where the risks are greater, and we have to mitigate those risks, and we expect trouble all the time. And that trouble can be political, it can be macroeconomical, it can be weather related, since most of our investments tend to be in either new technology or in land or in natural resources. So you have to learn how to mitigate all those risks and change a risk into an opportunity. What you need to make sure that these things are all there is obviously having all the paperwork, which includes the teasers that you can send out to people to judge their interest, the presentations that actually show what your project is about and what you need the money for, and then the budgets, and then the full information memorandums, which could be anything from 40 pages to 150 pages long, and explains every aspect of your business and includes all the team and how that team will actually ensure success. And then you need, obviously, all the third-party validation, whether it's from the big accountancy firms or from the firms that will actually do the work to determine what type of assets you've got under the ground and whether they're economically viable over a period of time. And also ensuring that paperwork is acceptable to these financial institutions. This is, people have mentioned previously about bankability. You need a piece of paperwork or validation from a company that is considered bankable, which other people will accept because their reputation's at risk. And then having that startup capital. Without that startup capital, it makes it very hard to actually move forward. And so you need, when you first get a project, you need to understand how much money do I need to raise for the project. What do I need to spend it on? I need to make sure I have a good team, because you need a good team that can deliver. Without a team that can deliver, you can't move forward. So you need to ensure that you have enough money for at least a year for a good team of people that can come on board and actually help you deliver your project. You need money for your lawyers, for your brokers, for your nomads, for the accountants. You just need, and I would suggest that, you know, the minimum startup capital for most projects has got to be around that $1.5 million band. More depending on the project, less on certain other projects. But it needs to be fairly substantial to actually make sure that the people who look to invest in you understand that you've taken the time and effort to make it all work, and that you've developed the right team that is a successful team that can deliver results. Otherwise, they just will not invest, and then you waste a lot of time. So having money is great fun to spend it, and I've seen a lot of companies that tend to be lifestyle companies for directors. Sadly, it's true, but they just spend money doing the bare minimum and ensuring that they have a wage for a long time. You've got to make sure that you're going to have a decent return on capital, and in certain parts of the world, you need a greater return than other parts of the world to attract the investors, because of the associated risk involved with some countries in the world. And one thing that people tend to do to raise money is overpromise and underdeliver, which is definitely a no-no. Investors are very clever. They want to understand, obviously, the process and see all the validation, but they like people that underpromise and overdeliver, the opposite way around. And that's a good habit to start with, because whilst you will tell people what you have, the investors and the people that participants that have been talking earlier, they know what you have. They will look at your paperwork and look at your reputation and your deliverability in the past and determine whether or not what you've said is real. And if you're over promising, they will see that. And if you have a good asset and they see that you will fail at some point, they can use that to gain more equity and more interest in your particular company. So it's very important that you actually understand everything properly and without any doubts, and be able to deliver on time, on budget, and in the right way. Happy to take questions from anybody.
Yes, I'm back. Nigel, that was excellent. Thank you very much. All the speakers have been good so far, and we come to our final speaker of today. We still have time for questions after this last speaker. So please, Nigel, stay online, and I'm sure there will be many for you. I'd like to introduce Altenbek Yusatov, who's the Director General of Alamak Proxima, and he is also going to talk on the same subject of investor-friendly projects and how to get them to that position. Altenbek, I hand over to you.
ladies and gentlemen, thank you for your attention. Today I will talking a bit about set of new technologies and technical solution. This set of unique technology which is not analogous in the world. This technologies is burning after uranium mining in Kazakhstan, and the solution of technology of extraction of the gold from oxidized ores by underground. So this is most important set because it have too much priorities and a little bit non-understanding like technology cycle, but this is very complex technologies. So today is metal mining moving is the next evolution stage of development, which can be called the stage of chemical for molecular mining. The new method is finally replacing the expensive and dangerous for mankind and nature's ancient mechanical mining. New ways of extraction raw materials without explosions and ore mass from bowels have gained and solid place, especially the uranium industry. There are no significant emission for the atmosphere. The depth average production has increased 700-900 meters. This is not finished because now have is 150 to 1,000 meter. You know, typical now technologies using 300 maximum 600 meter. That's why is more like 1,500 meters downstairs. Environment standards, respect for naturals. This is connected with the ecology, security. By the beginning of the 21st century, almost major deposits in planet were already under development. As a exploit reserve declines in metal consumption in the world, taking into account rapidly changing needs. So that's why you have two way to mining areas. For first one is the short and medium term production or poor fleets of the ICL method. Second one, a long-term perspective, is a shelf. This is waterline and ocean and sea in shelf. So we are ready for to date for receive. You have patent for these technologies. You have two patents to gold, nickel, cobalt, and you have patent for new generation for extraction items. This is very interesting items because this is like very high speed, like now working items like pure light items. So this is I have priority for speed 10-100 times. This is most important because this is like a time machine. You have 100 years, you have 10 years, you take like push inside 1 year. But a very good position in laboratorium, finish it, all of us study and take gold in outside. So search most important sorry, my bad English. Search starch campus laboratory studies show very high inquiry indication. A degree extraction gold, other metals from poor ores now is walking diapason 0.3 to 2 gram per ton ore. This can serve basis new technologies, area mining, industry, many valuable. Might look like this is world revolution in the mining gold and platinum. This is most important message for big gold production companies. And same situation like in uranium also. This is same, but inside this time changes too much priorities. You see, if you look at these pictures, this is you have two blue shell and one red. This is outside and inside. So this is deeper now, regulated for 1,000, 2,000 meters downstairs. And this is new era with mining, because traditional technologies coming not more for in practically not more to 250, 400 meters. And this is opened new era with mining in this moment. So I'm finished, and I speak about this can be served basis in new technologies in mining industry, many valuable metals. This indeed I broke out as a technology extraction, precoce metals prospect. This technology is very promising. The chemical molecular mining will change many subsectors in metallurgy. This has already been confirmed on global scale by the example for uranium mining in Kazakhstan. So important moment as this record low production cost. Yeah, this is netto price for mining metals is very cheaper. So second factor plus for these moments, you take for jork approximately 1 gram per ton. In fact, molecular mining take it 1.5, 2 grams. This is very interesting fact. Also, you have twice double profitable with take it, and you have double price cheap with mining also. So is mining low metal welcome all of us who is interested in these technologies. We have a full package with patent and secret авторское право. So we military cooperation with all of us. If you have my contacts, also if you have Mr. Matt, and you have too much commercial metals, and my vision in this moment is Kazakhstan is big country, 9th position in the world, and in Kazakhstan, poor areas for mining area. This typical problem with in Kazakhstan working mining company, and if you working some very fast and cheaper, this is in this moment I think bursting revolution with this technology. Thank you very much for your attention.
We have been switched over, I believe, to the Zoom meeting, which we have another 40 minutes for. I will wrap up at the end of that Zoom meeting, but in the meantime, let's take questions from the delegates to those presenters who are still online. The first one is from to Tim and Tamara. The question is, if a company considering listing opportunities, would you recommend them start with local exchange and only then pursue a dual listing and consider an overseas exchange? Very good question. Tim, I see you online. I'll leave it to you to answer that.
Yeah, look, that's certainly the pathway. And one of the things that, as I mentioned, is that the listing rules, by and large, are very similar between exchange venues now. So certainly once an asset is in production, then the reporting requirements and regulatory requirements would be very similar. And increasingly, exchanges recognise other jurisdictions. So, we recognise London, Hong Kong, and a couple of other exchanges. So the key is for a company considering listing to look at where they think they can raise the most capital initially, but also where they're going to get that investor attention and hence liquidity, get a good mark on the business or asset. And then if they do want to do a secondary capital raising, then you could go to a global exchange as the valuation or the size of the asset increases.
Thank you, Tim. We'll move on to the next question. And this one's for Oscar. How do you assess the local banks to approve the credit guarantee? What is the procedure? We know that there are some mining companies in Kazakhstan you were in touch with on the UKEF offer. However, due to some circumstances, the negotiations were put on hold. What do you see as the main obstacle for Kazakhstani mining companies to apply for the UKEF loan? Now, there are a couple of questions in that, so I'm going to break it down, if you don't mind, to help you. Firstly, how do you assess the local banks to approve the credit guarantee?
I hope you can hear me.
Yes.
Okay. Yeah. Now, as in every project finance, and that wouldn't matter whether it's mining or healthcare or infrastructure in any country, it's better to have a strong bank with you, which had international financing experience. Local banks, that is possible, obviously, to have a local bank. But I think one of the critical success factors is to have a bank that has the expertise in raising international financing. So that's very, very important to have that bank, because that bank will help you to talk with ECAs, to UKEF, to others, and present the project in a sense that the credit analysts and the risk analysts will understand. Now, I'm not aware of the previous experience that you mentioned, but Kazakhstan is a country that is obviously very acceptable in terms of doing ECA financing. We have limits that we could look at. I think the gap here is that maybe the reason that we're having this conference, that the expectations by the international financial community, including ECAs, including stock exchanges, private equity funds, banks, debt capital markets, is quite stringent. I think the best to start is to have the advising bank with an experience in mining in Kazakhstan and raising international financing, and have an information memorandum ready to approach the ECAs. That is probably what I can suggest.
Thank you. There was a second part to that question before I get to the next one. What do you see as the main obstacles to finance for a Kazakhstani company?
As I said, Kazakhstan is obviously in the risk scale of OECD is is not great, but is not at the lowest level either. It's somewhere, you know, in an acceptable position. So again, I don't know the specific case on mining, but usually, you know, in project financing schemes, the biggest obstacle is not being able to present, you know, all the project dynamics from a creditor's eye for the ECAs. I think that is the biggest gap. I mean, you can have your conversation as an entrepreneur, which may be very attractive to, you know, finding an equity partner, where, you know, for a lender, for a debt financier, the risk profile and the things that they're going to pay attention are quite different. So the best is to have a strong advisor with you. And you know, I would recommend to have it as early as possible. And if it's an internationally active bank, investment bank, that makes things much easier. If it's a local bank, you know, happy to talk to them as well.
Thank you very much. The next question is for Altenbeck, and the question is, do we rightly understand that the technology that you described, which allows extraction of gold, platinum, and some other valuable metals from pore solutions, is it already been implemented in Kazakhstan at the moment?
Yes, in this moment, my company found 1,470,000 ton gold, and we connected with Russia National Academy, and this is old academic guys, and you have big academics before Soviet Union speaking about 50,000 ton in Russia. My way, I am working now in Kazakhstan, and I have two plots. Totally is approximately first level before 500 meters, approximately 10,000 ton, 3 plots. So how my company calculate this volume? We are drilling.
Altenbeck, can I just put in there? Please don't hold your microphone close to your mouth. Please let it. That's fine. Thank you.
So my company is drilling over the Shurf and 500 meters. And you have in this moment more money for this work, and because territory is incredible big. I in this moment for money in my company, I take only 50 kilometers by 50 kilometers. So I need approximately 1,500 kilometers by 1,000 kilometers this sector as a 3 plots. So we have more money, and Soviet Union information we connect possible coming in special program and computers, and you look Aluviev plast, and I'm looking with this old 60, 50 years before. But I look at now in future, and laboratorium in these moments working with concretely ores and concretely mine area. So in this technology building from uranium technologies, but uranium and gold mining different, absolutely different catalysator. And in this moment, I am only this work start before 6 years, 2014, and 2018 finished all of us laboratorium and mining gold from uranium, and this is gold every time like union with cuprum and uranium also. So in fact, 200 grams per ton in uranium, and first one in the world, and very cheaper price, net price. And gold have same pictures, and in this moment 147,072 tons, and down with only 1.2 maximize 2 grams per ton, you see. But this is very profitable, because you are looking with the 0.2 gram per tons. This is good, profitable also. And very interesting, you have very small speed, but this last one patented extractor, very high speed, and like traditional, like pure light, 100 time. Yes, this is like time machine. You also have Scrooge this time with 100 years for 1 year. This is incredible. Yeah. We are now patented these 2 patents and commercial secret in Switzerland, Zurich. This is not fast work, but if some people have a patent in your country, connect with me, and I also, if you have interest for this project, or you have some plans with mining gold or platinum, so connect with me, and I'm also thinking about with you how in your country patentable this for cooperation. Thank you very much.
So next question is for Osgor. As far as we understand,
yes,
you work with a local and international bank. Can you work with any local banks, or are there any certain criteria according to which you will be able to select a bank? Thank you.
Well, thank you very much. Just to repeat how it works is that we provide a guarantee and the bank funds the transaction. It's not the other way around. So the bank is actually taking our risk. We're not taking the bank's risk in terms of credit risk. Therefore, theoretically, we can work with any bank. But to be honest, the funding, structuring, arranging bank, the leading bank for the facility, if it's one bank or a syndication of various banks, it's a very sophisticated transaction. A project financing is not a simple loan. It requires a lot of due diligence, very tight documentation, a lot of feedback from advisors, usually coordinating multiple lenders, multiple ECAs. So although it's possible to run it with a local bank as a lead bank, it would require, and I'm not aware of any Kazakh banks in that league, it would require prior experience of raising international financing, project financing, documentation, structuring, due diligence, all these sorts of things, and application. So it's highly advisable not to cause any unnecessary delays and workarounds to have an international bank as an advisor. And this could be, as I said, doesn't have to be a UK-based bank. It can be any European, any American, Japanese, French, Swiss, German banks. We're happy to work with. I think if you look at the spectrum of the 25 to 30 lead banks, we're happy with all of them. But when it comes to local banks, as I said, the advantage disappears because of the lack of experience in being able to lead the financing. Now, if it's a local currency financing, you may need a local bank. That might be better because of the funding capability, but I would still keep an advisor and a lead ECA bank, an international player, maybe not with their balance sheet, but sort of being able to coordinate, these transactions.
So this is a question again for Tim. Do you think an IPO is a good solution to raising finance for early stage companies?
This is how long is a piece of string? Look, to go to the public markets, you need to have a credible track record in order to attract institutional investors. Now, how do you build that? Well, there are a number of different ways. As one of the earlier speakers said from one of the PE funds, they're happy to invest early stage, and that, as part of an exit strategy, the presence of one of these private capital funds obviously builds credibility of the asset. Second is, of course, the track record of the management team. Are there people on the management team who've done this before in this particular commodity, or are there other non-private equity shareholders who are involved in this project who have also got a successful track record? And you see that quite a lot in the Australian market. Well, finally, what does a reporting look like? Is it to the standard that an institution would expect in the public markets? And so if you don't have one or two, that becomes much more critical. And actually, I'd say the fourth thing, particularly given we're talking about Central Asia, is geography as well. A lot more appetite in developed capital markets such as Australia or Canada for earlier stage opportunities than there are in countries like Kazakhstan or the rest of Central Asia.
Thank you. Let's move on to the next one.
Matt, we cannot hear you, so I'll just read another question to all speakers. Did pandemic outbreak alter the way investment to money is being reviewed now? And if yes, how? So this is the question for all speakers. You could turn your cameras and microphones now and answer the questions. Thank you.
Here to answer this question. I mean, there's clearly a high degree of risk in terms of commodity prices. That's the economic impact that has an impact. But in terms of the types of projects we're talking about today, if we think about the time frames to getting these assets into production, then yes, there will be some delay. We've seen production drop in some mines in Kazakhstan, and we've seen some delays in terms of bringing things back into production. But in general, given the timeframes we're looking at for some of the earlier stage assets or juniors, I don't think this makes much of a difference. I would say, as one of the speakers mentioned, of course, health and safety is a big issue in the industry, and this will just reinforce the need to manage health and safety carefully.